Welcome to Deal Drivers TV, sponsored by Merrill Data Site. 2008 was a tumultuous time for deal makers, but what now for 2009? Today I'm going to be speaking with two M&A experts about what they think is going to happen in the coming year.
Well, a deal that we saw announced this morning from Pfizer in its proposed acquisition of Wyeth at $60 billion in cash and shares is certainly a large deal that I wasn't necessarily expecting to see in the first quarter of this year. So it's an encouraging sign in a sector that has often seen consolidation in difficult market conditions, and suggests at least that Pfizer are pretty confident of receiving good market support, which for a deal of that size, given what we're seeing in the market at the moment, offers some hope for the rest of the year. It remains the case that forecasting trading performance in a lot of businesses is extremely difficult. I think the speed of the downturn has caught people by surprise, and certainly talking to our clients, it's very difficult for them to forecast the remainder of the year. And until we begin to see some stabilisation of current trading and a little bit more confidence around some of the performance dynamics of business models, it's going to be difficult for people to feel that they can really get a grip on where the results are going to come out for the year. We certainly expect to see more share consideration to fund transactions and probably less cash. I think actually from a domestic standpoint, some of these banks under government ownership will still feel able to support domestic M&A transactions. It'll probably be in the cross-border M&A market where that dynamic will make itself felt. But whether it's sovereign wealth funds or perhaps in certain instances private equity, but perhaps even more important than that, banks who've weathered the storm such as ourselves coming through to support transactions, we're quietly confident that the money will be there for the right deal later on in the year. I mean, I think we're looking at a very selective deal market. I wouldn't want to be saying that they're going to be seen either as a ubiquitous feature or all across the market. But just to take a couple of recent examples, obviously the world is very interested in the future of Barclays at present, and as I've said already, I think they're going to be the Arabs will be quite a feature in the shareholder register of Barclays. But also, you know, for example, the rumoured takeover of possibly Chelsea or Liverpool Football Club that's being talked about this morning. Sector by sector, I think we're also seeing them in infrastructure and energy, oil and gas projects as well. So I think in the more defensive industries, they're making their presence felt. Last year, I think a lot of people were seeing them as a very important feature of the market. They did, to a certain extent, have their fingers burnt in the world of banking, and that, I think, led to an increase in caution. But from what we're hearing in the market, they're certainly around a number of interesting situations. I mean, I think the world of private equity is experiencing something of a flight to quality. There are a number of firms who found it difficult to raise new funds, and I think they will be forced to spend a lot of time focusing on their performance of their existing portfolio. There are some larger firms who have been successful in raising new funds, and undoubtedly they will be looking to put that money to work. In general terms, I think what we're waiting to see is stabilisation of the relationship between the private equity funds themselves and their limited partners. There have been a number of very visible and public issues between limited partners and private equity firms such as Permira. They're waiting to see that as an industry issue clear. And then I think as the debt markets begin to come back, you will see some selective activity, particularly from those firms that have raised new funds. But I think certainly from an M&A perspective, we're all expecting a much more muted level of activity. And I don't think anyone is really expecting to see a sharp recovery or a big bounce in private equity activity, certainly this year. We are certainly allocating a lot of resources internally to debt restructuring and distressed opportunities. Our private equity clients are telling us that a number of their portfolio companies are going through difficult times, challenging times. A number of our corporate clients are telling us that they may be in danger of breaching their covenants and will need to restructure their balance sheets. So I think it will be a major theme of 2009 and also of 2010, and I think you're seeing investment banks respond to that by setting up some reasonably significant teams to deal with the business flow. I mean, I think in the short term, it's difficult to answer that question because we've not really seen the full effect of government ownership. Stephen Hester, for example, at RBS said recently that he intends to reshape the management team at RBS. And I think until that happens, it will be difficult to assess what the new business model and new strategy, for example, from RBS will look like. I think also as we sit here today, we have an uncomfortable situation enveloping Barclays where there appears to be a lack of trust or confidence in the statements being put out by the board of Barclays, which is discomforting. And so I think in the short term, really for the next 6 months, it will be very difficult to assess the full implications of government ownership. Over time, we would hope that those institutions will re-engage with their client base and with the market and will support its evolution. But for now, I think we don't have that much clarity. Well, I think our perspective at the moment is we do see higher levels of activity in the more defensive sectors, so utilities, energy, power, oil and gas. Those sorts of areas you're seeing corporate bond spreads narrow. You have got, I think, quite good, if not robust, levels of investor confidence in the business models. You've got recurring revenue streams, and these businesses have been less aggressively impacted by the economic downturn. Those sorts of areas we've seen RWEs deal with Essent. We're seeing the Centrica EDF transaction going through the market at the moment. The defensive utility style industries, I think, have got a pretty healthy level of investor support, albeit in a challenging environment. We think it's too early for a significant M&A return in the more cyclical consumer-driven areas. But that having been said, we do expect in 1 or 2 areas, including food manufacturing as an example, some industry consolidation later on in the year. So my advice to an M&A practitioner would be, certainly for the first half of this year, focusing on the more defensive sectors would probably be a sensible idea. Yes, I mean, I think a number of the major healthcare players like Glaxo and AstraZeneca and Novartis have come out quite publicly to say that they are going to be disciplined and selective, and they are managing investor expectations that there won't be a very aggressive phase of industry consolidation. But as the Pfizer announcement for Wyeth suggests this morning, companies in that sector have clearly got ambition, and they are looking for investor support. And I'd also make one other comment. The Roche deal for Genentech is also going through the market, and again shows that in that sector, companies with ambition clearly have got an ability to execute M&A transactions. I think the biggest lesson, I suspect, is the importance of maintaining confidence in the industry model. And it appears as though the investment banking world has lost a lot of confidence, both from the standpoint of politicians, regulators, but perhaps most important of all, investors. So clearly, I think the lesson learned within all the boardrooms of major investment banks has been to ensure that the way in which the business model is managed is prudent. And I think the lesson of the last year or two is if it becomes imprudent, it can have some very significant and negative implications. I think 2009 is a year of rebuilding trust and rebuilding confidence. And in the case of a lot of banks, I think another lesson to be learnt is a new business model or set of business models will emerge. And I don't think in many institutions people know exactly how the future regulatory or political landscape will impact them. We've now got a number of institutions that are part government owned or majority government owned. How those businesses compete for business going forward is something of an unknown. And I think there is, shall we say, a mood of introspection. A lot of people are asking themselves the right questions and tough questions, but in most cases I'm not sure they feel they have the answers yet.